The Mortgage Bankers Association forecasts that within the next 2 years in the United States alone, $1.4 trillion of debt will come due. While much of this debt won't pose a problem, a significant portion of it pertains to office debt. Presently, the commercial real estate market is facing substantial challenges. Some experts suggest that these challenges may surpass those encountered in 2008. Analysts at Morgan Stanley have expressed concerns, noting that major office landlords are struggling to repay loans due to decreasing demand for office spaces. The situation is exacerbated by New York Community Bank, finding itself in a precarious position with numerous commercial mortgages requiring renewal in the coming years. The looming question is whether the commercial real estate market will crash in 2024. If you are new to the channel, please make sure to subscribe and leave us a like below this video. Recent years have witnessed a significant transformation in the commercial real estate landscape across the United States. One driving force behind this shift is the widespread adoption of remote work, spurred by the global pandemic. Millions of Americans transitioned to remote work during the pandemic, making it a new norm for many. This shift raises questions about the future of traditional office spaces and its impact on commercial real estate values. Another contributing factor to this transformation is the mass exodus of businesses from core urban areas in several large cities. Conditions in these areas have rapidly deteriorated, making it challenging for businesses to thrive. The prevalence of theft and violence has created an increasingly unsustainable environment. Despite the bleak current outlook, understanding these factors allows us to anticipate future changes. However, the current state of commercial real estate presents a significant challenge for financial institutions across the board. With a growing number of commercial real estate loans turning sour, financial institutions are facing a daunting predicament. The severity of the situation is evident, with many loans already in default and more teetering on the brink of collapse. This crisis signals potential failures in the financial sector, with institutions like New York Community Bank feeling the pressure. The recent turmoil surrounding the bank, including a credit rating downgrade and leadership changes, has sent shock waves through the financial world. Despite efforts by New York Community Bank to reassure investors about its financial metrics, including increased deposits and robust liquidity, market confidence continues to erode. The announcement of a change in leadership, with Alessandro Danello appointed as the new executive chairman, initially provided some reassurance. However, the crisis at New York Community Bank has deepened since January 31st, with the bank's stock plummeting and investor confidence diminishing by the day. However, the sell-off began to ease around noon. Yet, a shocking truth emerges. As NYCB's stock plunges, other regional bank stocks are feeling the heat. This raises concerns about the broader banking industry's health. Shifting work patterns and high interest rates are also impacting office buildings and complexes. Analyst downgrades and news of executive departures are fueling fears and adding to the downward spiral. Moody's highlighted the departure of two crucial executives, the Chief Risk Officer and the Chief Audit Officer, which has sent ripples through the financial community. CEO Thomas Canemy addressed these departures, acknowledging the need for new leadership. New York Community Bank's troubles can be traced back to its response to a crisis in 2023 that affected other regional banks. However, it's not alone in facing difficulties. Hundreds of U.S. banks find themselves in trouble, with banking stocks falling on a widespread basis over the past week. The KBW Nasdaq Regional Banking Index, comprising mid-sized bank stocks, has plummeted nearly 12% in just the past week, raising concerns about lender stability and their exposure to commercial real estate loan portfolios. The aftermath of the pandemic has fundamentally changed the way we work, wreaking havoc on the commercial real estate market. Lenders confront the daunting challenge of the maturity wall, with up to $1.5 trillion in commercial real estate loans coming due this year and next. This raises questions about whether the federal government will intervene. Treasury Secretary Janet Yellen has acknowledged that some banks may be stressed by this problem, but she believes it's manageable, downplaying worries of a wider crisis. However, the situation remains complex, and it remains to be seen whether they can contain the damage. A crucial program implemented last year to support banks is set to expire next month on March 11th. The Fed's Bank Term Funding Program, which provides low-interest loans to distressed lenders, will cease operations. Established in response to the collapse of Silicon Valley Bank, the program aimed to help lenders stabilize their finances affordably and restore public confidence in the banking system. However, sinking share prices suggest that investors remain skeptical of this message. Furthermore, turmoil in the commercial real estate market isn't confined to the United States. It's sending shockwaves globally, affecting banks even in distant countries like Japan. For instance, Aozora Bank, the 16th largest bank in Japan, has experienced a significant drop in its shares due to the devaluation of its U.S. office tower loan portfolio by over 50%. Similarly, banks in Germany are facing challenges. Troubles in the U.S. commercial property market have spread to Europe, causing concerns about broader contagion. Recently, Germany's Deutsche Bank AG witnessed a slump in its bonds amid worries about its exposure to the sector. Responding to these concerns, Deutsche Bank issued a statement acknowledging increased provisions due to persistent weaknesses in real estate markets. Meanwhile, the return to office work in the U.S. has been slow, leading to substantial value destruction. Some experts warn that the full extent of the damage may not yet be apparent. Analysts at Green Street are cautioning that further write-downs of up to 15% may be necessary this year, as appraisal values remain unrealistically high, posing risks of substantial impairments for lenders. This could strain financial institutions as they grapple with the fallout. The warning signs are evident not only in the United States, but also in German lenders' bonds. Deutsche Pfandbriefbank, PBB, for instance, has seen its bond prices decline rapidly after Morgan Stanley advised investors to sell its bonds. Bonds due for repayment by 2027 dropped by over 5 cents to 97, while other notes, called 8% notes, also experienced significant declines, dropping by as much as 15 cents to 36. Despite these challenges, Deutsche Pfandbriefbank maintains that it remains financially robust and profitable. However, refinancing remains a significant risk as asset values continue to decline. In Europe, Julius Baer Group Limited faces its own set of challenges, announcing substantial write-downs on loans to the bankrupt property company SIGA. This isolated incident has sparked concerns about the potential spread of financial distress throughout the region. As these issues unfold rapidly, quick action is essential to address them effectively. They have allocated an additional 210 to 215 million euros to prepare for potential bad loans this year, aiming to reassure stakeholders of their ability to weather tough times. Sonia Forer, an analyst at Morningstar DBRS who evaluates banks' performance, noted that Deutsche Pfandbriefbank, PBB, has been prudent in selecting lending opportunities and managing loan-to-value ratios. However, she emphasized the importance of remaining vigilant for challenges such as liquidity issues and meeting the demand for new loans. In the financial markets, Deutsche Bank's stock fell by approximately 3.7% in Frankfurt, while Commerzbank AG dropped by 3.2%, underperforming the Euro Stoxx Banks Index. BaFin, the German banking regulator, acknowledged monitoring the situation but refrained from singling out specific banks. Last year, Germany's central bank warned of the risks associated with commercial real estate, highlighting the potential for increased loan defaults and subsequent losses for banks. The prolonged scrutiny on Deutsche Bank raises questions about its stability. Amidst ongoing financial turmoil, diversification of assets becomes prudent to mitigate risks associated with potential bank failures. While the federal government may manage a few bank failures, a widespread crisis could overwhelm its capacity. As we navigate unprecedented times, it's essential to appreciate the current relative prosperity but remain prepared for unforeseen challenges ahead. If you enjoyed this video, please make sure to subscribe to the Financial Scoop and leave your thoughts down below.